Hey everyone, and welcome to today's explainer for May 1st, 2026. So, if you've been keeping an eye on the charts, you know April was just completely dominated by all that massive geopolitical drama and those super high-stakes prediction markets. But today, we are officially pivoting. The noise is finally starting to clear out, and what's left is a totally new foundation for the market.
And that actually brings us to a pretty crucial question. Who is really driving the crypto market right now? I mean, for years, the answer was super simple, right? It was retail FOMO and human sentiment. But as we're going to see today, something entirely different has taken the wheel. And honestly, it's changing the very mechanics of the market as we know it.
So here's our roadmap for today's explainer. We're going to be hitting on structural maturity, the massive agent economy, the new compliance floor, why miners are pivoting to AI, and we'll wrap up with the impending Bitcoin supply squeeze. Let's get right into it.
Welcome to structural maturity. With April's prediction markets like those Zcash $420 targets and the Strait of Hormuz wagers totally settled now, the speculative noise is basically fading out into a structurally mature phase.
Moving right along to Section 2, the agent economy. We are seeing a fundamental shift in how value actually moves on-chain. Okay, wrap your head around this number, $28 trillion. That is the staggering amount of volume currently flowing through the crypto agent economy right this second. It's wild. We're talking about machine-to-machine liquidity operating at a scale that is honestly kind of hard to even comprehend. It's a completely new paradigm for digital finance. And when you actually break that massive volume down, the results are pretty mind-blowing. 76% of that 28 trillion is quite literally just bots shuffling stablecoins around. Human-led transactions, they're making up only about a quarter of the volume now. But there is a catch here. Analysts are warning that while these agentic workflows are totally taking center stage, they still heavily rely on centralized gateways. So basically, the machines are out there doing all the heavy lifting, but human-controlled entities are still the ones owning the toll booths.
Now, this whole machine takeover is having some massive ripple effects in the broader society too. Elon Musk has recently started pushing this idea of a universal high income, or UHI, as the ultimate solution for AI-driven unemployment. His whole proposal suggests that as AI increasingly revolutionizes the workplace, using crypto-native distribution for these UHI checks could actually address both global inflation and job loss. It's absolutely fascinating to see how crypto rails are being proposed to solve the exact economic shifts that AI is creating in the first place.
All right, Section 3, the new compliance floor. Because obviously, with bots running a multi-trillion-dollar show, global regulators are absolutely stepping in to build a foundation.
Regulators are aggressively laying down the rules of the road. Over in the UK, the Financial Conduct Authority has officially opened its crypto consultation window, and they've set a strict, hard regulatory deadline for October 2027. So, the clock is officially ticking for firms to get their compliance operations sorted out.
And over in Europe, the shift is just as dramatic with the new MiCA regulations. I mean, think back to the Wild West days when you could just launch a project with, an informal PDF or a really basic Git book. Yep, not anymore. The new standard requires strict, formal legal disclosures just to be recognized. This new compliance floor is definitely going to squeeze out the smaller, non-compliant projects while really solidifying the dominance of institutional-grade assets. And projects are absolutely feeling the heat and adapting to this. Take NEO, for example. Co-founder Dahong Fei just proposed a massive $461 million treasury overhaul. The goal? To completely end this whole trust me style of governance. They're restructuring the foundation and returning tokens right back to the community to fix these long-standing governance clashes. So transparency, it's really no longer optional. Also, if anyone thinks bad actors can still just hide out on-chain, think again. Law enforcement is getting incredibly sophisticated with on-chain tracking. Just look at Brazil. Police there just dismantled a $320 million crypto laundering ring. They even arrested several high-profile singers in the process. This compliance floor isn't just some theory on paper. It's got real, undeniable teeth all across the globe.
Moving to Section 4, miners pivot to AI. This structural maturity is really forcing the physical infrastructure layer to adapt. Check out this pretty sobering statistic, 20%. Right now, a full 20% of the entire Bitcoin mining industry is operating at a total loss. Between the high mining difficulty and the tighter post-halving rewards, the math is just, it's just not mathing anymore for a lot of these operations.
So what exactly do you do when you've got warehouses completely packed with high-powered computers, but pure mining isn't turning a profit? Well, you pivot to the highly lucrative world of AI data centers. Crypto miner HIVE is our prime example here. They just announced a $75 million offering specifically to fund their massive expansion into AI infrastructure. They're following where the capital is flowing, for sure.
Now, you might be thinking, wait, aren't miners abandoning pure Bitcoin mining a bad thing for the market? Actually, it's stabilizing it. By pivoting over to AI and securing those alternative revenue streams, miners are seriously reducing what we call dump-at-any-price behavior. Basically, they don't have to desperately panic sell their Bitcoin reserves just to keep the lights on when network difficulty adjustments make things tough.
Which brings us perfectly to our final section, the Bitcoin supply squeeze. Let's tie all these pillars together and look at exactly what's happening to price action today.
Right now, the market is definitely experiencing some serious friction. Bitcoin is basically locked in this tug-of-war, stuck in what analysts are calling a Fed ceiling range right around $78,000. And on top of that, we've got these quantum sell-off signals in the derivatives market providing a real psychological drag. It's creating quite the heavy headwind.
But hey, do not let that bearish friction fool you. Underneath it all, we are currently seeing massive whale accumulation literally at its highest levels since 2013. So while everyday retail investors might be distracted or feeling a little hesitant right now, the biggest institutional players and the smart money, they are quietly scooping up absolutely everything they can get their hands on.
What we're witnessing is a massive absorption event. All that smart money is effectively soaking up the record sell pressure from those transitioning miners we were talking about earlier. So with whales buying up everything aggressively and the surviving miners finding brand new revenue in AI, we are looking at the very real potential for a massive supply squeeze later this month. I mean, the sellers are quite literally running out of inventory. Which leaves us with a really fascinating question to wrap up today's explainer. If AI agents and bots are now dominating a whopping 76% of all transaction volume and smart money is just quietly accumulating regardless of the day-to-day news cycle, are traditional human sentiment metrics like the Fear and Greed Index even predictive of price anymore? Like, are we trying to analyze human psychology in a market that's fundamentally being run by machines? It's definitely something to chew on as we move deeper into this new era. Thanks so much for joining me to unpack all this source material today, and as always, keep learning.